With so many ways to trade currencies, it can be hard to figure out an approach for yourself. Many turn to simple and reliable market patterns to help them make informed decisions in the market. Market patterns are on-chart price action patterns that offer significant clues on future price movement to technical traders. In today's lesson, we'll talk about some common market patterns you can identify to increase your probability of winning. Let's start with reversal patterns, which occur when a price pattern signals a change in trend direction. First up, double tops. A double top is an extremely bearish technical reversal pattern. It forms after an asset reaches a high price at resistance 2 consecutive times with a moderate decline between the two highs. It is confirmed once the asset's price falls below a support level, as represented here as the neckline. This pattern will usually occur at the end of an exhausted uptrend. Now that we've gone over double tops, let's get into double bottoms. The double bottom is just the inverse of the double top. It is an extremely bullish technical reversal pattern that forms after an asset reaches a low price at support 2 consecutive times with a moderate incline between the two lows. It is confirmed once the asset's price rises above a resistance level equal to the high between the two prior lows, otherwise known as the neckline. You will usually find this pattern at the bottom of an exhausted downtrend. Alright, so now let's get into the ever so popular head and shoulders pattern. The head and shoulders pattern is formed when an asset's price rises to a peak and then declines back to a level of support, otherwise known as the neckline. Price will then rise above the previous peak to form the head of the head and shoulders pattern, and then decline back to the neckline again. The asset will form a final peak at or around the same level of the first peak before falling back down to the neckline for a final break through support. Now that we understand the head and shoulders pattern, it will not be hard for us to understand the concept of the inverse head and shoulders pattern. So let's get right into it. The inverse head and shoulders pattern forms when an asset's price falls to a low and then rises back to resistance, represented here as the neckline. Price then falls below the previous low to form the head of the head and shoulders pattern before pushing back up to the neckline. Price will make a final move down and then stop at or around the same level of the original low before its last move up and through the previously defined resistance level. The head and shoulders pattern will usually be found at the top of an uptrend, while the inverse head and shoulders pattern will usually be found at the bottom of a downtrend. Now let's talk about another reversal pattern called the rising wedge. The rising wedge is formed when price consolidates between two upward sloping support and resistance levels. It begins wide at the bottom, and as price moves higher, the trading range contracts and narrows until price has no choice but to break through support to the downside. Now let's talk about the falling wedge. The falling wedge is formed when price consolidates between two downward sloping support and resistance levels. It begins wide at the top, and as price moves lower, the trading range contracts and narrows until price has no choice but to break through resistance to the upside. Now that we have learned about some popular reversal patterns, let's get into some well-known continuation patterns. First up, the falling wedge. And yes, there is a reversal and continuation pattern called the falling wedge. But don't forget, right now we're only talking about continuation patterns. As a continuation pattern, the falling wedge will still slope down and consolidate between two support and resistance levels, but the slope will be against the ongoing uptrend. Price will move lower as the trading range contracts and narrows before breaking through resistance to the upside. As you may have already assumed, there is also a rising wedge continuation pattern. The rising wedge as a continuation pattern will still slope up and consolidate between two support and resistance levels as well, but the slope will be against the ongoing downtrend. Price will move higher as the trading range contracts and narrows before breaking through support to the downside. The next continuation pattern we're going to go over is probably one of the easiest to identify, and it's called the bullish rectangle. The bullish rectangle is a continuation pattern that occurs during an uptrend when price pauses before moving up. Price will usually consolidate or move sideways before the breakout occurs up and through a previously defined resistance level. Now that we've gone over the bullish rectangle, it's only right that we talk about the bearish rectangle. The bearish rectangle is a continuation pattern that occurs during a downtrend when price decides to take a pause before its continuing move down. Price will again consolidate or move sideways before the breakout occurs down and through the previously defined support level. The next continuation pattern I want to go over is called the bullish pennant. The bullish pennant is a continuation pattern that occurs in an uptrend after a sharp rise in price. It resembles a flag as price moves sideways, making gradually lower highs and higher lows. This pattern gives investors an opportunity to enter or re-enter on a trade to profit from the continuing move up. Now that we know about the bullish pennant, let's go ahead and get into the bearish pennant. The bearish pennant is a continuation pattern that occurs in a downtrend after a sharp dip in price and gradually makes lower highs and higher lows. This pattern also gives investors an opportunity to enter or re-enter the trade to profit from the continuing move down. We've talked about reversal patterns, we've talked about continuation patterns, but now I want to talk about bilateral patterns. Bilateral chart patterns are patterns that indicate that the currency's price can move in either direction. First up for bilateral patterns, let's talk about the ascending triangle. The ascending triangle pattern is created with two trend lines that act as support and resistance. The first trend line will be flat along the top of the triangle and acts as resistance, while the second trend line that slopes upward acts as support. If price breaks through resistance, investors will take that as a signal to buy, and if price breaks through support, it will be an indication to sell. Now that we understand the ascending triangle, we will have no issues understanding the concept of a descending triangle. The descending triangle is similar to the ascending triangle in the way that it is created with two trend lines that act as support and resistance. In this case, the first trend line will be flat along the bottom of the triangle and acts as support, while the second trend line that slopes downward acts as resistance. Again, if price breaks through resistance, investors will take that as a signal to buy, and if price breaks through support, it will be considered a signal to sell. Last but not least, when it comes to bilateral patterns, let's go ahead and talk about the symmetrical triangle. The symmetrical triangle pattern is characterized by two converging trend lines that connects a series of highs and lows. The top trend line, aka resistance, will slope down, while the bottom trend line, aka support, will slope up. Price will bounce between the two trend lines and either advance through resistance as a buy signal or break through support as a sell signal. That concludes this lesson. If you have any questions or remarks, please join my discussion board and make them known. Feel free to follow me on social media and leave this emoji under a recent post for a follow back. Thanks again for tuning in to Money with Mari, and I'll see you on the next episode of Forex 101.